Hello everyone, welcome to the Bowtie Breakdown. I'm Garry Morin The BowTieGuy. Thanks for tuning in. Today I am at Anchor Financial here in Pawtucket. I'm with my friend Joe Baptista. Joe is joining us today to tell us the pros and cons of an adjustable mortgage. Joe, thanks for letting us come in today and bring our equipment. So we always hear ARM or adjustable rate mortgage. Can you tell us what does that mean and what does it entail?
Right. Well, what is an ARM? Right?
Exactly. It's not this, right? I'm not like working out.
Right. Exactly. Well, you want to make sure the arm doesn't work in the wrong direction.
Right.
That's for sure. So everybody's trying to get the most affordable mortgage they can.
Yep.
Right. So whenever we see an increasing rate environment, which is kind of what we have now, and today, right, rates have kind of come down.
Yep.
You know, so we're in a decent rate environment right now. But whenever you see an increasing rate environment, people are always saying, well, how can I do better? You know, because rates are going to eventually come down. We all feel that rates will eventually come down. So, you know, one way that you can try to maybe lower your mortgage payment, what's advertised out there is these adjustable rate mortgages, right?
Yep.
It's just like everything in life, there's risk and reward, right? And to me, the risk has to, the reward has to outweigh the risk. Right? I mean, because
the benefit has to outweigh the negative.
The negative, right. So, first of all, you have to really look at what you're saving, right? What is the difference between your regular 30-year fixed rate and what the adjustable rates are, right? And what an adjustable rate is a loan that's going to be fixed for a certain period of time, and then after that change. And there's a couple different versions that you can get out there. There's one that's fixed for like 3 years. There's one that's fixed for 5 years, and there's another that's fixed for 7 years.
Okay.
So for the first 3, 5, or 7 years, that rate is fixed. But then after that, it adjusts.
What does it adjust to? Like,
right.
What does that mean?
How high can it go?
What
where are we going?
Yeah.
So there are what we call caps.
Okay.
But those caps are scary. The caps are scary.
I've heard things, and I might be jumping ahead. I've heard something about like balloon payments and those kind of things.
Little different from adjustable. We can talk about that real quick. But there's just the uncertainty, because you may say to yourself, well, I know in 5 years, I'm out of here. I'm gonna relocate to wherever. But what if in 5 years you don't?
Right.
Or I know in 3 years, my kids are graduating from school, and we're gonna do this, that, the other thing. But what if it doesn't?
Life happens.
Things
change at the snap of a finger.
And the scary part of these adjustable rate loans, so you can tell probably I'm not a big fan of these adjustable rates.
I can definitely.
You get that feeling. You get that feeling.
Yes.
So I've owned Anchor for 22 years now. I don't think I've ever given anybody adjustable rate.
Wow.
Yeah.
Wow.
Unless they've really requested it. Because
so in 22 to 23 years, Joe, who has been in this industry for that long, has never given an adjustable rate mortgage. That kind of tells you something right there, borrowers.
Yeah. So it's just not. You don't know what the market's going to be when that loan comes up, right? So 5 years from now, you think, well, I was going to sell or whatever, but if you didn't or you don't, and then you're subject to what the market is, and if rates are higher at that point, you can go up 2% in that first year.
Oh, wow, okay.
Are you going to be ready for that?
Right.
Are you going to be ready? 2% on a good-sized mortgage,
so there's no way,
$500 a month.
There's no way to predict what you're going to be paying.
Unless you have a crystal ball, you don't know where your situation is going to be and what the market's going to be at that point. And God forbid, property values come down.
Yep. Now.
And you can't refinance.
Now you're stuck in that loan. Or if you can't afford it.
And for what? To save a half a point?
Yeah.
To save a point on the rate, to save $50 a month or $100 a month. Risk versus reward.
What is the reward of this? Would be what you're getting the lower rate in the beginning.
You get the benefit of the lower rate in those savings in the beginning, and for some people that could make a huge difference.
Right.
But to me, if $100 a month is going to make or break you buying that house,
you shouldn't buy that house.
I don't know if you're ready for it.
Yeah, exactly.
I don't know if you're ready for it.
I don't think you should. You should consider coming a little bit lower then.
And the other thing about the adjustable rates loans is that they just don't price out well. So meaning that you're going to have to pay something up front for them. So I always what we have structured my company to do is to try to do all loans with no points.
Yep.
No points, no broker fees, no processing fees, no underwriting fees.
Again, saving the money out of the borrower's pocket.
Right. Less money out of pocket at the closing, right?
Yep.
So with an adjustable rate, you're not going to be able to do that. Because the bank knows that it's a short-term loan.
Yep.
So they're not going to pay the same premiums for that loan. So basically, the bank's not going to pay us for processing the loan when they know that you're going to be refinancing the thing in 3 years.
Yep.
So we'd have to charge you an upfront cost for it.
Oh, okay. So that's where some of the fees would come into play.
And people don't like to, I don't know why, but just tell people how it works.
Right.
You know what I mean? Just tell people how it
That's
works.
why I'm glad we're doing this video today, so people can understand what is an adjustable rate mortgage, what are the benefits, and what are the risks. Because a lot of people don't know.
If you're an investor, you know, and you want to play with these types of loans, go for it. But for your average homeowner that's not savvy enough to understand, and I'm not saying that people aren't savvy or whatever, but you know, just unless you know what you're really doing, you don't want to mess with something like that.
Gotcha.
It's just not worth it.
And that's great information, again, coming from a professional who's been doing this for almost 25 years, 30 years, telling you that's not your best option. No matter what option is out there, that's probably not the best.
There are other ways. Let us talk with you about other ways to do it. Yeah, for sure.
You heard it first. If you have some questions about any loans, contact my friend Joe here at Anchor Financial in Pawtucket. That was another Bowtie Breakdown. Thanks for watching. I'm Garry Morin. Again, this is my friend Joe Baptista.
Thank you, Gary.
We'll see you next time.
See you next time.